Welcome to The Explainer. Today, we're going to tackle a question that really gets to the heart of investing. It's this constant tug of war in the market between the promise of the future and the stability of right now.
So let me ask you this. What do you think builds wealth faster? Is it the high-speed tech train promising to get you to your destination in record time? Or is it the steady, reliable value bus, the one that just keeps on chugging along no matter what? It's a choice every single investor has to think about.
You see, the tech train, it's thrilling. It really is. It runs on the incredible promise of the future. But its tracks can be kind of fragile, really sensitive to the economic weather. The value bus, on the other hand, it's built for any kind of storm. It's not about being the fastest. It's all about the reliability of its engine, which is just stable, predictable cash flow. To really get to the bottom of this, here's what we're going to do. First, we'll look at the core question itself. Then, we're going to explore three hidden engines that drive everything: the economic climate, the timing of profits, and, of course, investor psychology. And then at the end, we'll put it all together to build a framework to help you navigate your own journey.
So why does the market seem to have this split personality? I mean, one month, it's completely obsessed with breathtaking speed and innovation. The next, all it seems to care about is resilience and stability. It really feels like a battle. But what's going on is actually something much more fundamental.
And you know what? This is the trap so many people fall into. Jumping from the train to the bus and then back again at all the wrong times, well, that's just a recipe for frustration. The key isn't trying to guess which one is going to win next week. The real key is to understand the deep structural forces that cause the market to favor one over the other. And that's exactly what we're going to unpack today.
All right, let's fire up engine number one, the macro climate. Now, this is going to sound a little backward, but stick with me. Sometimes what seems like genuinely bad news for the economy can actually be fantastic news for certain stocks.
This really captures the market's strange logic, doesn't it? You'll see a headline about slowing job growth, and your gut reaction is probably, oh, that's bad. But for the market, that can be a huge green light. It's a signal that the central bank might be about to step in and cut interest rates to get the economy going again.
So here's how that chain reaction plays out. First, some weak data comes in. That sparks hope for lower borrowing costs across the board. And the moment that happens, investors immediately start looking for the assets that are going to benefit the most from all that cheaper money. And this brings us to a really crucial concept.
It's a concept called duration risk. Now, it sounds a little technical, but just think of it like a seesaw, okay? On one end, you have interest rates. On the other end, you have the value of an asset. Now, for companies whose big payday is way, way out in the future, like a speculative tech company, their value is extremely sensitive to that seesaw. We say they have high duration risk.
And this brings us right back to our metaphor. The tech train is a high-duration vehicle. When the forecast calls for lower interest rates, its value just soars. But if rates start to rise, man, it can get derailed fast. The value bus, though, it runs on the cash it's making right now. That makes it way more resilient to the changing weather of interest rates.
And that leads us perfectly into our second engine, the payoff clock. This one is all about timing. Because look, it's one thing to invest in a world-changing idea, but it's another thing entirely to actually see that idea start generating real, spendable cash.
Just think about the massive hype cycles we've all seen, right? Like the recent explosion in AI investment. The first phase is all about potential. It's about pouring billions and billions of dollars into the technology. But then, inevitably, the market's mood starts to shift, and a brand new, much more practical question starts to pop up.
Yup. The whole conversation pivots from what could this become to what is this earning me right now? We've seen this movie before, even with the biggest tech giants. After all that initial excitement, investors start looking for cold, hard proof that those massive investments are actually turning into real profit. The market's patience, you see, is not infinite.
And here's the contrast in black and white. The value bus is making its regular stops. It's paying out dividends, it's generating earnings today. The tech train, on the other hand, is promising this spectacular destination. But the arrival time? Well, it's a little uncertain. And when investor patience starts to wear thin, they often prefer the certainty of the bus over the promise of the train.
This all leads us directly to our third and final engine, which is the human element, the investor mindset. Because at its core, the choice between tech and value is a psychological one. It really is a tug-of-war between two incredibly powerful forces, hope and patience.
Investing in tech is so often driven by these powerful stories, these grand narratives about what the future could be. And that hope can lead to absolutely spectacular gains, but it also creates a ton of volatility. Value investing, though, is an exercise in patience. It's driven by fundamentals, by the simple belief that a good business will eventually be recognized by the market, and that generally leads to a much, much smoother ride.
So you see, the two vehicles run on completely different kinds of fuel. The tech train needs a constant supply of exciting news, of breakthroughs, of hope for the future. The value bus, it just needs time, patience, and the steady hum of its fundamental economic engine.
Okay, so we've looked at the engines, we get the forces that are at play here. So the big question is, how do we actually use this knowledge for our own long-term journey? Well, the answer isn't to just pick one vehicle and stick with it forever. It's about learning how to balance the two.
Here's a simple way to think about it. Imagine your portfolio is a single vehicle. Tech is your accelerator. It's what gives you the power to speed up and really grow your wealth. Value, that's your suspension system. It provides the stability you need to protect you on those bumpy roads.
So how do you make the adjustment? Well, when the economic weather really favors speed, like in a time of falling interest rates, it might make sense to lean into that accelerator, to tilt a bit more toward the tech train. But in times of uncertainty, when the road ahead is foggy, you'll probably want to rely more on your stabilizers, on the value bus. The real key, though, over decades, for the long haul, is to always have both.
And that really gets to the heart of it, doesn't it? I mean, you would never want a car that only has an accelerator, and you definitely wouldn't want one that only has brakes. Building true, lasting wealth is all about combining that propulsive power with durable resilience.
So let's just bring this all home. This whole debate, it isn't really about one style being better than the other. The market isn't trying to crown a permanent king. It's just in a constant natural cycle, shifting back and forth between times when it craves growth and speed and times when it demands safety and resilience.
Understanding this cycle, that is the real prize. The ultimate question for a long-term investor isn't about picking a side in some epic battle. No, it's about understanding the map, knowing the terrain, and asking yourself, at this specific point in my journey, and in this economic climate, what's the right balance of speed and stability for me?
If you found this structural way of looking at the markets helpful, and I hope you did, you might want to consider subscribing. We'll be right here to help you navigate whatever turn in the cycle comes next.